Welcome to the Festival of Entrepreneurs, recorded live at the NEC in Birmingham. Over the next few minutes, you'll hear from some of the most incredible founders, investors, and business leaders who joined us this year.
Welcome to how Eggers think on how to prepare for debt financing between 100,000 and 4 million. So we brought together a really exciting panel to chat to you about very topic. So we've got a combination of funders and also a broker to be able to kind of construct that like key question, how do you prepare for debt financing? So I'm going to ask us to introduce themselves. In the second round, we'll kind of get into questions. We've got Seb Jarrett, who guides up the unsecurity at Swoop. You've got Dan, you've got operation and strategy within Funding Circle. And we are just insecure finance here in the UK. And then finally, we've got Sir Farr Together Mortgages, which I found out today is the UK's second largest privately owned business, which is pretty incredible. So, guys, you want to just do a quick round of introductions, if you want to start first, and then we'll get on to questions. Cool, yeah. So, Sajja, 6 years at Swoop.
So I head up around 6-year-old finance team, so helping SMEs within the UK with applications and managing their kind of growth funding requirements for unsecured borrowings. That'll be anything from debts, invoice financing, merchant cash advances, and a wide array of different products. Yeah, I've been there 6 years now and head out to these cases.
Hi, Rob. My name's Dan. I work at Funding Circle. Basically, Funding Circle, we're the biggest sector online. This is the finance fund for. So it started in 2010, have extended for the past 6 years. Billy worked correct to SMEs, but my role is to understand this performance and then drive the projects forward to make sure that we can say yes to as many businesses as we can.
Hiya. Oh, okay, that's fine. Right, so yeah, my name's Seb and I work together. Together are a 50-year-old property finance vendor. I look after West Midlands School, but I've been in finance for 22 years now, so I guess my age.
Super. Thanks so much. So let's get into it. Like one of the pain points we all know is as business owners or entrepreneurs, is applications. They're very tedious. You don't always know what to put in them. And the funding is pretty crucial. So when it comes to an application, you kind of want to get it right. So I'm really curious to hear, certainly if I start with you, when you get a funding application, what are the kind of key things you're looking out for? What do kind of business owners think about to kind of stand out, focusing on when it comes to funding application at Together?
So at Together, they're quite deep. They're not every finance case actually fits a box. So the biggest things that we look at are professing as asset, because we are a not-to funder. So the asset, location, demand for it, those are the key things. We go on to affordability. You've got to be a responsible lender. We look at the rental income. Or if it's a trading business, and what's the finances behind it. The purpose of loan is important. So that's one of the things that we look at. What's the money for? Is it a capital raise to go away and maybe repurpose a property? The type of finance short-term finance. So I'm quite big on the short-term finance and coaching is good for the right type of proposition. So is long-term finance is better suited than long-term finance is right for customer. But women's open to have those discussions. And then finally, the exit strategy. That'd be one of the things that we look at as well. So I think overall we're a common sense lender. So any organization that comes over to us that's property led, we see ultimate float defining, and that's what we need is to structure it, make it work as like in the area they want to be.
Super. So good Dan, a lot. Wait, Funding Circle Dan. a lot of it is starting kind of on the website. There's an algorithm that's really driving that initial journey when it comes to the application. So without giving away too much of the secret sauce, what is the algorithm essentially assessing and viewing when someone's putting through a funding certain application?
Yeah, so as Kieran mentioned, about 77% of our applications are automated. So, which makes it really easy for business owners to get the finance they need very quick. But regardless of the size of the loan, there are still some kind of important thing that we look at and serve them together. I've kind of bucketed them into 5 categories. So the first is financials. So also want to see either stable or a sustainable growth. Similar to serve as well, affordability. We want to make sure that borrowers don't make those repayments quite comfortably. And then liquidity and balance sheet as well. Helping you to release cash. The second is a bit of banking data. So a few things here, kind of incoming line with what we would expect. So we want to be seeing kind of a regular flow of income, add from sources that we expect. So we don't want to be sort of overly reliant on related companies, directors' loans, that sort of thing. Then clean banking conduct as well. So they pass payments, kind of regular payment station, MRC. So on then obviously we come to the credit profiles. So we look at the business profile. So is there kind of historic lending? Can you demonstrate that you've got some maybe borrowing in the past, like through a loan, credit card? What ultimately we want to be able to see where we can. But you are borrowing, you make those repayments. Clear with CCJs as well. A lot of businesses come to us not knowing they're the CCJ. So make sure that's an order. From the personal credit side as well, we are seeing a key credit file there, and ideally kind of 3 years plus on the electors role as well. The final thing, some discerned loan terms. So being really clear on the loan term, this is one of the funds can be used for, what return you're going to get, and is it within kind of our risk appetite as of industry that content.
Super, thanks. So you've got slightly different lens where it's not thinking about one singular product. So when you're chatting to business owners about how to assess for funding, and what are the kind of key areas you're looking at actually?
Yeah, so I mean, generally I'll have three things I want to be covering off when I'm assessing case lists for their eligibility for funding. So I'd always ask for 3 things. The first thing is the business generating at the moment enough cash flow to meet potential new debt obligation? So what that means is we'll be looking at a business's generally their statutory accounts. So those are the annual accounts that you business owners would be filing on an annual basis. With the turnover and the net profit and loss, so we'll be looking at the net operating income there, which is basically the cash available for further debt obligations. So funding circle and a match together as well. Probably be looking at that when they're assessing their affordability. So we'll be taking a look at that, and then we'll also be taking a look at their existing debt obligation, and it's working out what the additional capacity is post removing those existing debt obligations from their current net operating income or profit, essentially. So if your business is generating more income than they're paying in debt obligations, there's probably going to be scope to be borrowing further funds for corporate growth. Along with that, once we kind of ascertain that there is some scope there, we'll also be looking at their other financial reporting. So have they got a track record of financial stability? Are they producing their annual accounts with management accounts to support that? Because a lot of lenders will want to see an up-to-date view of the business. So are they producing management accounts? Have they got the statutory accounts? Have they got a track record with the statutory accounts? What else are people wanting to see? We want to be seeing banking data, so we'd want to be seeing good financial conduct. The bank statements, so you don't have a history of past payments, things like that. So just a full financial pack or along with that. So that's your bank statements, your statutory accounts, management accounts. If you can produce a financial forecast showing what the impacts of the loan is looking to take, that's also really useful. So just a detailed financial pack If it's something else, we'll be looking for. And then finally, we'll be looking at the security position. What security is available to underwrite the loan? And are there personal guarantees available from directors or shareholders? Is there property or assets within the business being leveraged? Yeah, I mean, I suppose those are the three key pillars, what we're looking at when we're assessing a business. Is there additional capacity? Have they got robust financial reporting so that we can provide that data to the lenders that we'll be speaking with? And what is the level of security that's available? Because that will really determine what funding opportunities are going to be available, be it interest rates, be it loan amounts, be it loan terms. If we can ascertain on those 3 points, we'll have a good idea of what's going to be possible for any business and need to raise.
Super. Så då purchase everybody kind of provide questions well as the investor, right? But obviously there's an individual behind it, there's going to be a team behind the business. How important, sir, for you is the person behind the application? Do you look a lot into their CV, the background, or how does that get weighted into your considerations?
Yeah, that's the personal aspect behind any individual is really important. I mean, the experience, background, don't forget that these together, we do support the first time buy-to-lets and people that are buying properties as well. So it's just understanding the customer as what the growth strategy is, and just getting close to that. But the easy answer, really, really important.
Yeah. And Dan, from a funding terms perspective, is it more on the financials led, or does the human quantitative? There you go.
Yeah, so I think naturally we look at both. I think that the nuances, the younger the business, the more important small growth for us. So really drilling into that and understanding again, so the business side, do you have a bit of a framework, do you have a mortgage, be able to show that, you're able to win these retailers. So that becomes more important for kind of less established businesses. And then certainly on the business side, as I said, is there evidence of, they're looking to debt, could also servicing existing systems. So it may matter, as I said, and the other dimension is more important, kind of leaned on.
Seb, you touched on kind of getting some signals from things like bank statements. Not everything is perfect. You might pick up things like bank statements, where Dan mentioned earlier on CCJs. You might discover they're not CCJ. Where you see things that aren't what's perfect, how business owners think about them, have they got options to look at funding, or is it something that they kind of, how do they deal with it?
Yeah, I mean, we'll see it quite frequently. Businesses they'll have cycles where they're like times where there's a lot of cash coming in, or there's times where the cash is a bit tighter, be it a seasonal business or just general variation in income. And then often get themselves into sticky situations where the business is operating fine, but it's just peaks and troughs in cash coming in, money being tied up in projects or invoices, and they'll end up negatively impacting their credit score, be it business or personal, by missing payments or not staying on top of their HMRC tax liability. And that's where, opening there's plenty of credit cards, revolving credit facilities in the market, which basically can eliminate those short-term cash flow pinch points. And it's just making sure you've got somebody who's assessing that. If it's not in the business directly, utilizing someone like Swoop, for example, where we'll be able to stay on top of that for you and identify those points of the year, the quarter, where there's going to be those temporarily fluctuation in business performance, cash reserves, and just make sure you've got that sort of facility in place and start that happening. So I mean, there's plenty of options out there. It's just making sure you're aware of when those are going to be and putting the facilities in place to eliminate that damage.
Yeah, Dan, you said that a bit from an awareness point of view, that some business owners don't realize they have a CCJ or a county court judgment.
is that a common mistake you see for people applying to the funding circle, and is there other mistakes that scale up businesses run into when applying for funding circle or using funding circle facilities that you've come across?
The thing that maybe limits kind of access to finance and these scale-up businesses is probably something that I'll probably come back to, which is kind of the ability to show, previous borrowing and kind of responsible for a lot of businesses that we see often have quite thin kind of business profile, and that then restricts what we can really often say if we are able to make an offer to a business. This is typically on quite a short term. So what that means is you're probably paying sort of as you want, maybe 1 or 2 years. So the monthly and a customer just makes it approximately to life. And so I think that the key thing is, in order to better manage that customer going forwards, trying to demonstrate that you are kind of able to make those rebates responsibly. So that when it comes to coming back to us in 18 months time, you can show that you've got this history of repaying the rate card, a short-term note, so that you're able to get the full return when you want to pay that. Let's say you're kind of unlocking terms of 5-6 years, which make those monthly repayments a lot more looking forward. It's for you as well.
I suppose together, is there any kind of common pitfalls you see observe in terms of applicants for together?
So I think the strongest applications are those that tell the story up front. So no surprises, no missing pages. Just tell us how it is. Like just going back to the credit search point. Anybody that's known to get together before would know that we're interested in customers' future, not their past. So where are they trying to get to? And I think the other thing is that, I've been in the banking industry for a long time, and what I'd say is that I know that a lot of businesses have to hand a series of favours before they get to their success. And, just talk to us about it, tell us about it, be transparent, and then that way, we know we can mitigate and we can work on those applications. But it's not closed doors together. Like we said, got such a nice range of clients, but just speak to us at the forefront as a more positioning and provide the rationales. Other common pitfalls would be that I've seen are possible security issues. So we take charge over a property, for example. If there's planning consent issues or maybe unusual construction, unregistered title. Just if you know about those beforehand, tell us and then stop it before it gets to safe animation. It doesn't risk fighting fire and after, right? And the only other thing that I'll just touch on is overstretched infinity. So just make sure that we'll back to the audience, but the commitments overall you're able to service will be written on. And actually, a lot of the times when you're taking on a property, there may be it unlocks rental income or a new income, or there's a strategy for the business as strategic purchase possibly and fire the commercial premises, and we know that that's for the pro. So again, we focus on where you're going to get to buy acquiring property. So we've got a nice range of customers and so many places that I believe of where we see many times in that way. But I think being transparent is absolutely key.
Yeah, I think that transparency point is so important, because I think a lot of business owners are probably fearful when they go to that application stage. Fearful for many reasons. Are we going to get the funding? How to put things forward? But actually, most experience, particularly when we're dealing with most lenders, if you're upfront and talk about everything, that builds that kind of level of trust. A lot of these lenders are coming in with an understanding that businesses do have creeks, they can't be told to us. And we're talking about lending 100,000 to 1 million here. We're not talking about lending 100 million plus. And a lot of these businesses will go through different phases. So as long as you're very upfront and explain that in applications, you'll get to see a lot more favourable attitude towards lenders, and it's probably not a natural thing that business owner will think about
when starting an application. I'd probably just to add to that, the number of times I'll be managing an application from the initial stage to completion, things that will come out kind of the day before they're meant to be completing all of that, which should have been squared off on day one, and then suddenly there's a massive roadblock to getting the deal over the line, which might end up impacting the rate the lender's then able to offer, the amount, the term, or potentially even the deal in the first place. So, yeah, being upfront and honest is always key from the get-go, because these things will come out eventually. So it's a relationship as well whenever you're partnering with a bank, a lender, alternative finance provider. So if you can give them the trust that you're going to be upfront, you'll reap the benefits in the relationship moving forward for further funding too down the line. Massively, I think that point around 5 days, so true. I'm sure as you walk around today, you'll see so many things around technology and AI. Well, all these banks and lenders are gobbling it, using it more and more and more. So there's not going to be a stone that isn't unturned through the process. So again, it's really, really important to go into it with a high level of transparency. So if I could kind of go back, because you've talked about a lot of your experience over the years, whether it's with NatWest and now with Together. I'm really curious when we talk about 2025 and accessing debt funding as a business in 2025. Is that very different to other years? Have you experienced it? Is there any changes in the trends? Like how are you finding it?
Yeah, I think people are, things are evolving, things are changing. You know, you mentioned technology, the use of AI, people are kind of using financial support a lot more now than ever before. So yeah, I think things are changing, and we're looking to we are. They're making things work for the clients. So yeah, they are moving.
Yeah, I mean, I'd probably add to that. I mean, I'm sure everyone's kind of been aware of the changes in interest rates over the last 3 or 4 years post COVID. So I mean, it's always it's a changing landscape. Interest rates are always fluctuating, which affects lender appetite. But I mean, just taking funding as an example, you're always quite dynamic in updating your pricing alongside the market. So there'll be trends where interest rates will go up for a period based on kind of generally global macroeconomic conditions, and then they'll come down again. So it's always an evolving landscape from a pricing perspective, liquidity perspective. And it's interesting to see, you'll see different industries or different sectors, there might be more capital available. So we know the AI space at the moment, there's a lot of cash floating around there for businesses looking to raise equity. Healthcare, edtech, all those kind of things also super active in the space. Yeah, I mean, I'd say, definitely always an evolving landscape. I don't know whether you got any other thing.
I'll just add to that point. I think it's a bit, actually seeing it's been have a lot more speculative things and stuff. And also, I think now, where traditionally, for example, buy-to-lets were just, traditional buy-to-lets, now you love maximising rental income from buying, support housing, using PDSA, and also using HMOs. So we're seeing a lot more of that. And then the other way this changes, high streets, fake high street screens aren't the best example. So they're being revitalised, they're being repurposed at the moment. And I think a lot of my freehold owners probably have had those high street properties for a while, and now they need the opportunity to go away and repurpose some, say, co-working spaces, especially upstairs. They need the chance to do that. So that's why that there is like us to give the car being highly opportunity to go away, refurbish those sites, and ultimately benefit community around.
Yeah, so that's pretty fascinating. Are you seeing kind of general trends in terms of what's leaving the high street, but equally what's now on the high street? Like, what would you guys be seeing?
So I think I've touched on it, and I think it's that opportunity to be capacity because people are using spaces as multiple spaces now. So, for your customers, it could be co-living upstairs, co-working downstairs to what the retail aspect, but we need to give clients an opportunity to do that. Because ultimately we need the high street. We need to give, and lenders, we need to give our folks the opportunity to go away and be practice. So these are about a opportunity in 2025 and to behave with.
Yeah, good. Dan, how was the kind of funding circle product evolved? You adapted James the product a bit this year, so is it worth kind of giving you a bit of an overview on what's a bit different now?
Yeah, so I think I'll start with kind of the macro now. So I think one of the things we've seen over the last couple of years is a real shift towards the challenger and specialty banks. So I think 60% of now very standard interesting is just very challenger specialist banks. So maybe when you think about funding, you would think about your bank. But I'd encourage you to think a lot more broader about banks, alternative finance providers, something called you're here today, right? So there's definitely a shift towards more funding being available and more diversified sources. I think internally, as Karen mentioned, we started out with just it's still bulk of what we do, but over the last couple of years we've really evolved our early turbine propositions that are say yes to no businesses, but introduced them products as well. So we've launched a line of product proposition and the business credit card as well. So we're always trying to find ways to support businesses, not just over a longer period, right? So over a couple of years per term loan, but on a monthly and that thing to support. So you're constantly looking to find ways to expand our credit box to kind of be at the day-to-day needs of businesses.
But you kind of see like a wider, like a range of more niche products in the market. So it's not just a bog standard loan over a fixed monthly payment. Lenders are constantly trying to offer interesting and innovative products to the market, which might better suit a business's needs. So it's not going to always be the case that the term loan over 5 years is actually the best fit. This is what you guys have, I suppose, you've launched with your new FlexiPay product, which is giving more short-term working capital solutions to businesses that don't necessarily need to take a long-term debt facility. So supporting the different needs that might otherwise not be catered to in the market.
Yeah, I suppose just to into that point a second, because if you're, again, going back to the business owner, it's quite hard to stay up to date with all the different products that you can go for with Funding Circle and together. They're at least relatively well understood. Term loan, you could be this money out, pay back a certain amount each month, and it's over a certain period of time. With people who are familiar with mortgages, so taking the leap into a personal mortgage or bridge facility isn't too hard. But when we look at funding and alternative finance for businesses in the UK today, there are so many different types of products out there. So yeah, Seth, particularly because obviously you're seeing all the different products. You're also having business owners come to you, which they probably don't know about these products. Like, what are you seeing as like some of the trends and the types of products that are coming out there, and which ones are business owners kind of wrapping their head around and getting, and are some of the business owners aren't really getting their heads around?
Yeah, I mean, I'd say 9 times out of 10, when a business owner comes to Swoop with an idea in mind of what they want, it won't be the best potential solution for them. So that's where, more often than not, they'll come to us with a figure in their head and a monthly repayment they want to be paying on it with a certain term, and it won't be, I know I alluded to it previously, it won't be the right opportunity there. So we're seeing, again, lenders launch these interesting products where it might be a FlexiPay facility, which is essentially they're funding business costs and spreading them over a longer period. So you might have a tax liability or a supplier payment that you need to make, which generally you're not able potentially to get on terms, or if they are, they're quite short term or high interest rate. Lenders are coming to the market with facilities where you, for example, spread that over a 12-month period. So unlocking cash that would have been tied up in paying that bill there and then and spreading it over a longer period. That's one example of a new interesting product come to the market. The invoice finance space has had a bit of a resurgence over the last few years, so we're seeing a lot more activity in that space across the high street and the specialist lenders in the market as well. I think to run through each product, I mean these are half an hour slots, so we might just have you. But yeah, I mean, I think that with the overarching theme is that there's so many different data streams in the market now that are not just a standard term-loan facility over against the payment, and often that won't be the best solution for a business. So it's incorporating an array of different products is often going to give the best solution to the product, be it an invoice finance like coupled with a term loan, but funding circle, and then a bridging facility together to refurbish the office that they're working at. So it's a combination, and it's just you're making sure you've got visibility on what that is key, because it's difficult to know what's available out there, and then that's, I suppose, where Sold by Sleep can come in and provide that service.
Yeah. And I think it just goes back to being an honest, but if you're a business owner and you talk about what you do, it's important to just describe what you're trying to achieve. Because the good news story is there's so many products out there, but sometimes it's hard to know what is available, but there is so much it could be out there, which is, I suppose, the main thing. So, but I just want to finish on a bit more of a practical side of things. So, if you are business owners and you are looking to take on debt financing either between 100,000 and 4 million, which is the title of this session, I'm going to want to go to initiate to our two lenders here. So if I take yourself, sir, first and say, I'd like to take out a 250,000 bridge loan facility with Together. How can I be kind of together ready, so to speak? Or what do I need to have in place for you to kind of assess me?
So yeah, that's quite cool. But yeah, I think we've already touched on a lot of the points already. But yeah, 250,000. First thing, we talk about the property. We talk about what type of product you want. There's lots of them with you. Because long-term products, we do like 25 years capital, we invest 10 years interest only, or we do original products. So it's about finding the draft product. Tell me what the loan is. What do you need the money for? I've just done a breach for somebody at the moment. It's called 11 monthly nothing. And at the moment, so Cardi telling to invest with bake. So, for that client, a 12-month breach was appropriate because that made the kids rent really 600,000. We loan at the other 12 months, and once it's done the refurbishment, will be a bit of pounds, then we'll much a longer term finance facility. So it's just about understanding what the customer needs, and what their exit is. If they are, we have a lot of properties that are purchased in auction. We have a brilliant auction team, and they know that speed is of the essence. And the way they work with these hands is absolutely brilliant. So if you bought an inch property, get that maybe back over to its next year size. So there's so many scenarios, but I think the security, your initial affordability, the terms of the loan, those are the very key things that are brought together.
Down, I suppose, I'm looking to kind of grow a business, one about 100,000. I'm going to putting sort of a high quantity investment. What do I need to kind of go through your process?
So I think I've summed it up there, kind of the main kind of key points. I'll go to some more kind of practical tips now. First is kind of having documents ready, so things like IDs, management accounts if you've got them. So we don't always be exposed to the accounts in our process, but they can use some more applications. So if you do have them ready, then I've signposted balance sheet there. So if you take down finance, says to the last financials of the accounts, understand that, what are the monthly repayments, what the interest rate and so on, just so we can better understand affordability. Next is financials. So for bigger applications, we typically ask for 2 years worth of financials. So they should cover 2 years for trading, and then to serve, be clear all in this way. What cards going to be used for, what industry, what if they generate, so that when it comes to any questions from an underwriter, you've got that to hand. And so you're not going to always take okay, platform source. There's the main takes us out.
Super. And yet, I suppose something different. I'm looking for, let's say, 500,000, and again, I want to grow my business. Kind of where are you trying to get, like, what key piece of information do you need for me to get started, to get solutions back? Well, I mean, I guess just to begin with, given we'll be having all the discussions with the funding department, and what we want in order to get the application ongoing is we want a detailed overview of the business and the founders, because we need to understand what they do. We need an idea of what the purpose of the facility is, because we need to understand how it's going to unlock the growth in the business, which is what we'll be pitching to the lenders. Again, similar to Serb and to Dan, what we'll need is clear financial back. So that'll be, again, statutory accounts, bank statements, management accounts if they're available, and then we'll have an assessment of it. And then it's just we'll need a bit of flexibility with the business owners. They need to understand the market is positioned where it is. We'll always give them a clear and honest overview of what's possible, and it's just being flexible around what's going to be possible. It might not be the exact thing you're after, but generally there will be a solution out there. But yeah, I mean, it's not too to talk to what these files are going to be up to.
Super. I actually in 5 more minutes I was going to open up to questions, so I'm obviously overrun by the waving hands to back by a couple of minutes. So I do apologise that we didn't get any questions away, but I'm sure the guys around afterwards if you do have any questions, and I hope you've got a bit of an insight into how lenders and also brokers think when assessing funding above 100 to 1 million. So thanks very much for your time today.
Thanks for watching this special episode from the Festival of Entrepreneurs. Our mission is simple: to help founders and business owners grow faster, think bigger, and take action. And if you were part of the event, thank you for joining us and being part of the community. And if you missed it, don't worry. We'll be back with even more ideas, inspiration, and opportunities to help you take your business to the next level. You can find out more and register for future events at festivalofentrepreneurs.co.uk.